Everyone loves a bargain when shopping, but when it comes to the stock market, most people see stocks falling and they panic. But more often than not, these undervalued stocks are the best opportunities to take advantage of. In this video, I'll walk you and John through 5 strong dividend stocks trading at their 52-week lows. I'll show you exactly why these stocks are down, why they're still fundamentally strong, and how much your $10,000 investment could grow if you buy while they're cheap. And at the end, I'll share one company that could turn a single one-time $10,000 investment into a $2.8 million portfolio that pays close to $10,000 in monthly dividend income. Let's get right into it, and as we move from number 5 to number 1, the portfolio values keep getting bigger and the upside keeps growing. Kicking things off at number 5 is Marsh and McClennan Companies with the ticker symbol MMC. When you think about global leaders in professional services, Marsh and McClennan sits at the top of the list. Founded back in 1871, it's one of those companies that has adapted and reinvented itself for over 150 years. Today, it operates with a workforce of more than 90,000 people spread across 130 countries, offering a mix of insurance brokerage, risk management, reinsurance, and consulting. But now, it's down close to 10%, hovering around its 52-week low. That might make some people nervous, but it could actually be a quiet opportunity. What's unique about Marsh and McClennan compared to its competitors like Aon, Willis Towers Watson, and Gallagher is its scale and global network. It's not a niche player. It's a company that can serve Fortune 500 multinationals, mid-sized businesses, and even individuals with specialized advice. That breadth is hard to replicate. Add in the fact that MMC has been strategic with acquisitions, like its purchase of Jardine Lloyd Thompson a few years ago, and you get a picture of a company that not only grows organically, but also strengthens its position through consolidation. So why is the stock down? Well, like most financial and consulting firms, Marsh and McClennan is sensitive to the broader economy. If corporate budgets tighten, consulting demand can slow and insurance pricing cycles can shift. And that's what we're seeing reflected in the share price right now. But long-term, this is a company that generates strong free cash flow, grows its dividend year after year, and remains essential in an increasingly risk-aware world. Speaking of dividends, MMC currently yields about 1.8%, which might not seem flashy, but the real story here is consistency and growth. Over the past decade, the average annual dividend growth rate has been 11.27%, and the average share appreciation has been 14.44% per year. Combine that with stock buybacks and disciplined capital allocation, and shareholders are rewarded in multiple ways. Now, let's say John puts $10,000 into this investment today and reinvests every single dividend he gets. Here's how the projections look. After just 1 year, his investment would grow to $11,624. Fast forward 10 years, and it'll be valued at $44,128. Stretch it to 20 years, and John's investment will be worth $187,622. And by year 30, his initial $10,000 is projected to reach $776,443. Paying around $43,896 in annual dividend income, or about $3,658 in monthly dividend income. Out of that, $722,547 would come just from capital appreciation, and $43,896 would come from reinvested dividends. So the total value added to the initial investment would be $766,443. Next on the list, at number 4, is Booz Allen Hamilton Holding Corporation with the ticker BAH. This is one of the biggest players when it comes to advising the U.S. government and major corporations on strategy, technology, and security. Founded over a century ago, the company has built a reputation as the go-to consultant for defense, intelligence, and federal agencies. What makes Booz Allen especially relevant today is the way it's pivoted from traditional consulting toward cutting-edge technologies like artificial intelligence, cybersecurity, and even quantum computing. In fact, one of the biggest headlines this year was Booz Allen's expanded partnership with Seek to advance quantum computing solutions. The vision is bold: accelerate the bridge between quantum hardware and software so government and enterprise clients can access large-scale quantum power sooner. For a firm that already dominates the government consulting space, attaching itself to quantum is a way of signaling to investors that it intends to stay ahead of the curve. If that sounds niche, it is. But it also gives them a massive edge in a space that's about to explode. Now, the stock has taken a hit. It's down around 38%, trading close to its 52-week low. That's a big drop, and it's mostly because of short-term headwinds. People have been cautious after recent earnings reports showed slower profit growth and tighter guidance for the coming quarters. Government spending delays have also weighed on results. For a company that earns the majority of its revenue from federal contracts, that uncertainty matters. Still, the long-term demand for Booz Allen's services looks solid. Washington is continuing to invest heavily in digital transformation, cybersecurity, and artificial intelligence over the next decade or so. Booz Allen has a record backlog of contracts and has secured several new awards, including projects with the Air Force and Customs and Border Protection. These deals provide revenue visibility that smaller firms just don't have. On the dividend front, Booz Allen pays out around 2.2%, which is higher than peers in the consulting space. The company has a track record of dividend growth with an impressive compound annual growth rate of over 15.76%. Not to mention, despite the short-term drop, over the past 10 years, it has averaged 14.18% share price appreciation each year. Importantly, management has kept the payout ratio relatively low, which leaves room for further hikes even if earnings wobble in the short term. So, what happens if John invests $10,000 in this stock? Here's what the projections look like. After just 1 year, his investment would grow to $11,640. Fast forward 10 years, and it'll be valued at $46,309. Give it 10 more years, and in 20 years, John's investment will be worth $222,018. And by year 30, his initial $10,000 is projected to reach $1,108,281, paying around $32,942 in annual dividend income, or about $2,745 in monthly dividend income. Out of that, $895,145 would come just from capital appreciation, and $213,136 would come from reinvested dividends. So the total value added to the initial investment would be $1,098,281. If you think these numbers look good, wait until the end where I'll show you one of the best 52-week low stocks and how $10,000 in it could grow to $2.8 million, paying close to $10,000 a month in dividends. Coming in at number 3, we've got UFP Industries with the ticker symbol UFPI. This is one of those companies that doesn't make headlines every day, but plays a massive role behind the scenes in industries that affect all of us. Originally known as Universal Forest Products, the company has evolved far beyond lumber. Today, it's a diversified manufacturer and distributor of wood, packaging, and building materials with a business model built on flexibility and scale. UFP organizes its operations into 3 key segments: retail, industrial, and construction. On the retail side, it supplies big box stores like Home Depot and Lowe's with everything from decking materials to fencing products. In the industrial segment, it provides custom packaging, pallets, and protective solutions for manufacturers. And in the construction market, it serves builders with trusses, wall panels, and other structural components. This diversification is what sets UFP apart from being just another lumber stock. See, lumber prices are notoriously volatile, but UFP sidesteps a lot of that risk by focusing on value-added products, things like pre-assembled fence systems or construction components instead of just raw boards. This strategy drives higher margins and makes revenue streams more predictable. The standout factor is UFP's ability to pivot when one market slows. If housing construction weakens, demand from industrial customers or retail DIY projects can pick up the slack. That balance makes UFP far more stable than a pure-play lumber supplier. Now, let's talk about dividends. UFP's forward yield right now is 1.52%. That might not jump off the page at first, but here's the real magic. Their average dividend growth has been an incredible 17.87% per year. That's exceptional. It signals a management team committed to sharing profits with investors while also keeping plenty of room to reinvest in growth. Over time, the compounding dividend growth often outpaces higher yield but slower growing alternatives. That said, the stock has recently pulled back, trading near its 52-week low. For long-term investors, this is intriguing because you're getting a company with strong fundamentals, smart capital allocation, and exposure to multiple end markets at a discount. UFP doesn't have the glamour of a tech giant, but it's a solid company fundamentally. And its average share price appreciation of about 16.92% annually backs that. So what does that look like in real numbers? Let's say John invests $10,000 into this stock today and reinvests every single dividend he gets. After just 1 year, his portfolio would already be worth about $11,844. Fast forward to year 10, and it'll grow to $54,629. 20 years from now, John's account is projected to grow to $302,424, and by year 30, that original $10,000 could snowball into $1,698,754, paying nearly $28,563 every year in dividend income, or about $2,380 a month. Out of that, $1,517,725 comes from capital appreciation, and another $171,030 comes from reinvested dividends. In total, that's $1,688,754 of value added on top of John's starting investment. At number 2, we've got Brown and Brown, with the ticker symbol BRO. This might not be a household name, but it has grown into one of the fastest rising insurance brokerages in the entire country. The company has been around since 1939 and is based in Daytona Beach, Florida. Over the decades, it has built a reputation for helping both businesses and individuals make sense of the complicated world of insurance. But here's what makes them different. They don't actually underwrite policies. Instead, they act as the middleman. They connect clients with coverage, earn fees and commissions, and avoid the risks that traditional insurers carry when claims pile up. This asset-light business model means BRO doesn't have to take on claims risk like insurers do. Instead, it benefits from the recurring revenue and high margins even when the broader insurance industry faces turbulence. In simple terms, BRO gets paid whether insurance claims go up or down. The company operates through 4 main segments: retail, national programs, wholesale brokerage, and services. Retail is the largest, offering property and casualty coverage directly to businesses and individuals. National Programs specializes in niche markets like professional liability or workers' comp. Wholesale connects smaller brokers with carriers, while Services focuses on risk management, claims, and other support solutions. This diversified structure allows BRO to tap into multiple revenue streams while keeping operations flexible. One of BRO's biggest strengths is its acquisition strategy. Instead of pursuing giant risky deals, Brown & Brown makes steady bolt-on acquisitions, often buying up smaller local agencies and rolling them into its network. This approach has compounded growth for decades. Over time, BRO has built a broad footprint across the United States with more than 500 offices. They're local enough to build trust, but big enough to leverage scale. When it comes to dividends, BRO is less about yield and more about long-term compounding. The current dividend yield sits at 0.64%, with a 10.55% dividend growth rate. But the real growth engine for this stock is the average share price appreciation, which is around 19.82% over the past decade. So what does this look like if John invests $10,000 in BRO? Let's find out. John's $10,000 in this stock after 1 year would grow to $12,046. In 10 years, that portfolio will be valued at $63,216. By year 20, John's investment will be worth $390,841. And in the long run, his initial $10,000 after 30 years is projected to reach $2,396,166. Out of that, $2,377,502 would come just from capital appreciation, and $18,664 would come from reinvested dividends. So the total value added to the initial investment would be $2,386,166. And finally, at number 1, topping the list is Interparfums with the ticker symbol IPAR, currently trading at its 52-week low. This is the underdog of the list, and it might be the most surprising. Interparfums is one of those companies that flies under the radar because it's carved out a premium niche in the global beauty and fragrance industry. Founded in 1982, the business develops, manufactures, and distributes prestige perfumes under license agreements with some of the most recognizable fashion brands in the world. Brands like Mont Blanc, Jimmy Choo, Coach, Guess, and Ferragamo. Instead of building its own household brand, IPAR's model is all about leveraging partnerships with luxury fashion houses to create and distribute its fragrance lines. Here's how it works. Luxury fashion houses want to expand into fragrances, but they don't have the expertise or the distribution muscle to make it happen worldwide. That is where Interparfums steps in. They handle product design, manufacturing, marketing, and global distribution, while the fashion labels provide the brand power. It's a win-win. The fashion house expands without taking on risk, and Interparfums earns a long-term revenue stream. What makes Interparfums particularly attractive right now is how it has consistently grown revenues and profits even in tough macro environments. The fragrance industry has proven resilient through economic cycles, largely because perfumes are considered an affordable luxury. When consumers tighten budgets, they may skip a vacation or delay buying a new car, but a $100 bottle of perfume often still fits. This dynamic has helped Interparfums weather downturns. Compared to giants like L'Oreal and Estée Lauder, Interparfums is much smaller, but that's actually a strength. Its nimbleness allows it to quickly adapt, sign new licensing deals, and grow faster on a percentage basis. Management has been disciplined in keeping debt levels low while reinvesting in expansion, which provides financial flexibility for future opportunities. Dividends are another part of the story. Interparfums' forward dividend yield is about 3.16%, which is solid for a consumer stock. The average dividend growth rate has been an incredible 18.34% per year, and the stock's average annual appreciation is 16.72%. That combination, high yield, rapid dividend growth, and strong share appreciation, is what makes this company such a strong compounding machine. Now, let's say John puts $10,000 into this stock and lets it grow. Here's what the projections look like. After just 1 year, John's investment in Interparfums is projected to grow to $11,988. In 10 years, it's projected to be valued at $62,542. 20 years from now, John's investment will be worth $410,887, and by year 30, John's initial $10,000 is projected to grow to $2,859,221, paying around $118,261 in annual dividend income, or about $9,855 in monthly dividend income. Out of that, $2,225,301 would come just from capital appreciation, and $623,920 would come from reinvested dividends. So the total value added to the initial investment would be $2,849,221. Want to know the fastest way to reach $3,300 per month in dividends? Click the video on the screen to find out.